Opened today down 3% in the NASDAQ and the Russell. The two often departed from one another, joined at the hip to the downside. That happened as bonds were lower. Eventually, Bitcoin rolled down too. Let's bring in Michael Purves. He's the CEO at Tallback and Capital Advisors. Mike, we booked you to talk a bullish trade on banks, so nice timing with your letter on that to clients. But first, calm me down, Mike, because when I look at these high correlation sell-off days, it just the signals start flashing that something might be wrong. What do you think? Is something wrong here?
Look, I mean, I think we've just had a big event yesterday with the FOMC where a lot of things happened, right? You know, 10-year yields pushed through, you know, a key resistance level. The Federal Reserve increased its GDP expectations to over 6% just yesterday. So there's a whole bunch of things. And the market reaction, you know, you saw the dollar weaken yesterday, get stronger today. You've seen some of the obvious pairs work in the direction you would with rates climbing and all that. I hear you, Oliver. The oil move today was certainly not something I was expecting, and it seemed to have come out of the blue a little bit of a strong dollar. But you know, I think there's what I call a lot of algo tripwires embedded in all these markets, which have been, you know, just so heavily financialized, and there's so many robots running around that are often run by very large firms, where if certain things add up, you know, it's a series of if-then statements, and you can see these big aggressive pivots. So, but when you step back for a second and you think, if you're long equity, should I be worried? You know, look, you know, a few things. Look, the NASDAQ took it on the chin today, but if you were the worst market timer in the world and you bought the Qs on September 3rd, after that massive rally and overextension, just held on to them, you'd be up something like, you know, 9 or 10% through today's close, right? I mean, it's not such a horrible thing. And that was a hugely underperforming asset here. And the S&P year to date is up 4.5%.
For the S&P,
so.
NASDAQ, you're only up 3% since the SEP high. But same point,
yeah,
still
okay.
up.
So
yeah, Mike, well, if I could jump in real quick, because as you mentioned the kind of tripwires, what about the human kind of investment planning element here, where it takes a 2% drop, it seems, to put some kind of bid into the U.S. Treasury? I mean, what are we going to hedge with? Is that where the bank trade comes in? Is like tech was the safety during quarantine? Will banks be the safety in the recovery if bonds are down and that's complicating the tech bull case?
Well, look, I'm not, you know, I think I'm not sure I would define the long bank trade as a safety trade. I'm not sure I'd use those choice of words there, but I think you're touching on something really important, and it's a sort of a theme that I've been writing about over the last several months, which is that safe havens, the conventional safe havens coming out of last year, are just all in a somewhat, you know, they're not static, right? I mean, you know, the dollar's not necessarily a safe haven. The 10-year Treasury is certainly not a safe haven. Gold's not necessarily, you know, a safe haven, right? So a lot of those go-to safe havens, when you really want to say, you know, sort of get out of a risk asset and jump on something that's presumably safe, well, it's sort of you have to choose your safety tool based on what's happening within that, and so it's a more complicated exercise there, right? So you know, it's a very muddled water, thanks to this extraordinary policy we've seen from the Fed and also from Congress and around the world over the last year.
Mike,
it makes the safe haven issue much more nuanced.
What do you think we're learning about bonds? If someone had thought that we were going to be in the clear for contained yields because of the Fed's policy, is that out of the water now? Is the cat out of the bag?
Well, Oliver, my hat goes off to you. You kind of really nailed it with this.
Thanks, Mike. I appreciate that.
With this, you know, the back end is going to keep floating higher off, you know, at a dovish Fed. So look, I think ultimately, you know, bonds will find the back end will find support given where we are with respect to sovereign yields overseas, and where we are, you know, just simply, you know, by virtue of the fact that there is, you know, there's something to work with here. You know, when you're up to 1.7, 1.8%, the rationale for getting long bonds is a lot more apparent than at 1%, right? So, and you even had that old sort of long Treasury as a hedge, you started feeling it just in the afternoon session today, where you saw the yields come in and
yeah, finally worked a little bit.
With that acceleration to the downside in equities.
Yeah. Okay, Mike, let's trade some banks here, okay? Because of yields, if they move up or if they move sideways, they've moved and banks have loved it. So it seems like we're entering at least an environment in this kind of short-term, intermediate term, where banks are this momentum trade that was one of the few that ended up higher on the day. The only sector that remained higher. How do you want to trade this group right now, Mike?
Well, look, I put out a note to my clients earlier today on the large banks, and I was using Bank of America as a sort of picking on them as a good proxy here. But if you step back for a second, we know a few things. We know GDP is going to be really good this year and most likely next year. We know the yield curve is expanding, and we could see the 210s or whatever keep expanding. There, we have a robust trading environment in the stock market, as you well know. The capital markets activity should be robust too. And yet, so when you step back on the macro side, risk is on, right? We know risk assets are on, but we also know that there's a lot of things that are really expensive. And when I look at Bank of America trading at 15 times, 2/3 of the S&P multiple, it's an under-owned asset. Just in the last few sessions, it's taken out very significant long-term resistance there. So a little bit of capital inflows into this area can go a long way, right? Over the last 6 years, we've had this conversation where tech just sort of seemed to be, big tech used to just sort of be a black hole for inflows. It was such an easy way to allocate right now. So if some, risk asset allocations start moving more into banks, for these obvious reasons of earnings acceleration, net interest margin expanding with the yield curve and all that kind of stuff, that it looks like pretty good risk-adjusted returns right now.
All right, so the Bank of America moving with the yield curve, the risk-adjusted returns look good on the banks still, even after the run. I think that's an important point here, as you're saying that this is kind of approaching it from like a trade that's still high and moving, but potentially acquiring some more momentum and kind of breaking out.
Oliver, if you look at a chart of like the XLF ETF divided by the QQQ ETF over the last 7 or 8 years, you'll see that, yes, that has started to normalize a bit, but given the macro backdrop, I would say a lot more normalization can come. And, again, we are dealing broadly with a risk-on environment, but the question is where do you want to be risk-on with the yield curve steepening the way you saw it steepening? Again, my hat goes off to you. So I think, it's a proxy yield curve steepening play there, but also with the benefit of attractive relative valuation, probably some earnings acceleration. A lot of the loan loss provisions will probably be, provide some additional buffer for earnings in the coming quarters and so forth.
This is good fundamentalism.
And loan activity should go up with the GDP acceleration we're seeing. We should see an expansion of loan activity. That means more money. You want to be long big banks into an aggressive economic expansion.
Seems like it. Relative strength versus Qs here, turning up. Mike, my producers are telling me I got to go. We're already over time, but can you give me a 30-second response on this one? We didn't have planned in our discussion. Mike, you going to short ARK again? Because last time your ARK short kind of nailed it.
Yeah, it's a tricky short. There, and you're dealing with a lot of retail sentiment here that is kind of amorphous but powerful, and I think you have to pick your spots carefully for that. I'm not ready to go back in and pull the trigger. I am watching it every day, and I think at some point it will be really good. But I want to see some of the technicals and some of the sort of the broader market conditions set up before I go in with put spreads.
All right. Thanks, Mike. Good to catch up. Appreciate the shout out too on bonds. Man, thank you, Mr. Purves.
You earned it.
CEO.
Thank you.
Thanks a lot. He's CEO of Tallback and Capital Advisors, making the case to go long banks here.